If you want to be a future homeowner, you need to pay attention right now. What I'm about to tell you is based on straight facts, with overwhelming evidence to support it. In 6 months, rates will be 100% a lot lower and save you thousands of dollars. You'll be able to see so many more homes for sale. You'll be able to negotiate $50K plus off an asking price. The war conflicts will be over. The Strait will be open with zero issues. Everyone will be able to buy a home at the right price. And this nightmare, it will be over. And the future will look 10,000% better than it did today. Everyone should not be buying until the market gets back to a better position. So just pause.
You create the world of the dream. We bring the subject into that dream, and they fill it with their subconscious.
How could I ever acquire enough detail to make them think that it's reality?
So, newsflash, none of what Manley just said had any teeth or evidence. Not the lower rates, not the flood of inventory, definitely not the 50,000 negotiation certainty, not the war resolution, not the better market position certainty. And yet for a moment, it probably felt true enough to become part of your actual buying plan.
And I think TikTok does not talk about solving any problem.
It's like a casino, isn't it? For the dopamine.
Yeah, it's so bad. And they use a hypnosis technique, not just TikTok, this is everybody, called fractionation, which is where you bring somebody up and like you'll see one of those videos of a grandpa holding his grandbaby, like that makes you almost cry. Have you ever cried just watching like a 60-second Instagram reel?
Yeah.
I have too, man. And I feel stupid. I'm by myself watching a 60-second video. But like they'll pull you down into that. Then they'll punch you back up like 2 videos later, and you'll start to notice this. 2 videos later, it'll be a riot, someone robbing a store, fist fight, a car going way too fast, flipping off the road, an airplane almost crashing. So they get you up and down and up and down. And the more I can do that, this is proven that ramps up suggestibility.
That is the modern day inception, the seed that gets planted. Wait until the market is in a better position. Then social media just reinforces it. A few days later, that source disappears. The feeling survives, and the belief becomes, I should wait. The better setup is 6 months away.
And that right there is how consumers get trapped every single day. They don't remember the reel. They don't remember the thread. And they certainly don't remember who said it. They only remember how it made them feel. And once that feeling gets accepted as truth, it starts shaping what they do with their family's future. That false memory can now cost $40,000 to $80,000 in hesitation, lost leverage, and missed appreciation. Let me repeat that so that sinks in, because the seeds being planted in your memory through social media make sure that you stick to the script. That false memory can now cost you $40,000 to $80,000 in hesitation, lost leverage, and missed appreciation.
Yeah, so the real truth is this. Human attention is the single biggest commodity of the 21st century. The machine is no longer just hoping you make the right decisions here. This is what makes them the most money. It has now evolved into planting the seeds that walk you straight to the finish line of its agenda. That is exactly what today's episode is about. How there is a modern day inception happening right now to every single consumer every single day through social media and how it's shaping what they do, but more importantly, what they don't do.
Let's start with some facts and stats right out of the gate. The modern day inception is not about fake videos. This is 100% facts, and it's happening right now. It's all about what those videos and headlines and narratives cause people to do with their money. This is not a conspiracy. This is a measurable behavioral finance. The first dream level being created is when the first emotional version of reality reaches people before verified local market data does, aka planting the seed with false info. That can be an AI-generated Iran strike clip, a fake recession countdown, or a housing reset headlines that says rates are going back to 8%. Or the most expensive phrase in real estate we're seeing right now is, I'll just wait 6 months. Once that emotional version lands first, buyers begin pricing fear into their behavior.
Exactly, Manly. Let's start with the national baseline as well. As of April 2026, the U.S. housing market now has roughly 45% more sellers than buyers nationally, which translates to approximately 630,000 excess sellers in the market right now. That's the largest buyer advantage we've seen since 2013. So the measurable cost of hesitation, it starts immediately. Redfin's median monthly payment is now running around $2,600 a month, which means one extra year of hesitation burns roughly $31,000 in annual housing payment equivalent. Redfin still projects 1% home price appreciation in 2026 alone. Could be even more. And on today's $415,000 medium priced house, that equals another $4,100 in missed equity growth. So before we even talk about leverage, the first planted hesitation already cost payment burn and missed appreciation. That's real money attached to a synthetic fear loop.
Now, let's split the national dream into local realities, because this is where the audience learns whether they're living in a Miami math or Milwaukee math. Take Miami, where sellers outnumber buyers roughly by 152%, or Fort Lauderdale, where it's near 122%. Some metros currently offer 2 to 3 times the national buyer leverage window.
Yeah, but now let's talk about why the national dream can be financially dangerous in places like where you're at, Manly, in Wisconsin. Take Milwaukee, where buyers still outnumber the sellers by 25%, meaning this market is not yet in a true buyer's environment. Now, let's quantify the chain reaction of waiting. In spring inventory, if it tightens by, say, 5%, a local market, say, with 10,000 listings, loses 500 homes, that immediately changes the competition. So instead of seeing 1 to 2 offers per strong listing, buyers can quickly face 3 to 5 offers, especially in the 3 to 450 range. Then comes speed. If days on the market compress from 38 days average to 24, buyers now lose 14 days of decision time, which is roughly 37% less time to negotiate, inspect, and more importantly, compare options.
And now let's add the financing layer, because this is where hesitation compounds. If mortgage rates bounce from 6 to 6.5%, the principal and interest payment on a $400,000 loan rises about $125 a month, or roughly $1,500 per year. Over 30 years, that same half-point move adds nearly $48,000 in total interest costs. So now the machine doesn't need to be right. It only needs to plant the hesitation seed long enough for you to feel the payment burn, the appreciation miss, the local leveraged loss. That financing delta, it's $48K lifetime. That turns the planted seed into the potential of $50,000 to $80,000 financial consequence.
That's right. And this is the first dream level, right? It's not fake content. This is not conspiracy. Fake certainty that delays action long enough for the math just to get worse.
So the question every listener needs to ask is this: are you making your housing decision based on your local numbers or based on the fear the machine planted before your market data ever even showed up? So, if segment 1 proved how fear gets planted, segment 2 is where we prove how the machine gets people focused on the wrong number. Yes, the markets are moving violently, and we've lived it in real time. The 10-year Treasury moved from 3.96% to 4.33% in roughly a month. That's a 37 basis point swing. The 30-year fix also moved from 5.98% before the Iran escalation to 6.4 to 6.57% today. That's another 48 to 59% basis point repricing in barely 30 days. That is real volatility. But here's where the modern day inception traps buyers. They take a $100 to $150 payment move and emotionally turn that into, I need to stop everything. That's the wrong math.
Yeah, exactly. And let's translate that in real math, right? On a $400,000 loan from 5.98 to 6.4, that raises principal and interest about $123 a month or $1,400 annually. At 6.5% rate, what we're seeing, it's about $151 a month or $1,800 annually. So even if we round up to the psychological pain point of, say, $200 a month, that's still only $2,400 per year. That's the key. The machine gets people emotionally frozen over a number that is tiny compared to the cost of waiting. Because segment 1, we've already proved hesitation can cost $40,000 plus in payment burn and missed appreciation, as well as lost leverage. And in some zip codes, it's $50,000 to $80,000. So the math simply does not favor hesitation over the rate noise we're currently seeing.
And here's the scarier part. If buyers allow themselves to freeze over the first $100 to $150 payment move, what happens if we get the same volatility cycle 2 or 3 more times this year? Now that's the same $123 payment. It goes up. And then another $123 on top of that for the second similar move. And then the third similar move, that's an additional $123. Now we're talking about $370 per month, roughly. Round that with spread volatility and lender reprices, and now buyers are realistically staring at $400 to $500 higher monthly payment risk. That's about $4,800 to $6,000 annually. Now that rate hesitation finally starts becoming real, but by then the opportunity window may have already begun.
Yeah, and that's the whole lesson here, right, Manly? The key story is not rates are moving violently. The key story is understand what's truly at stake here versus what's being said or what's being planted. So what's being said is, hey, rates jumped, we need to wait. But what actually is at stake is $40,000 in hesitation penalty, lost buyer leverage, future multiple offer compression, higher lifetime interest if the volatility repeats itself. And we're looking at $400 to $500 a month in future payment risk if we see 2 more swings. So buyers should not make a home ownership decision based off of the first $100 payment change, because that first swing, it's manageable. The third swing, that's when it starts to hurt. And the only way to protect against that third swing is to stop waiting during the first measuring swing. That's the battlefield outside the battlefield we're currently seeing.
Anthony, so the real question becomes, are you making a housing decision based on a $2,400 annual rate increase while ignoring a $40,000 to $80,000 hesitation penalty? Because if that's the case, the machine successfully planted fear around the wrong number. So let's tie this whole thing together, because this is where segments 1 and 2 become the real inception. Segment 1 proved hesitation can cost somewhere between $40,000 to $80,000 in missed leverage, appreciation, and payment burn. And Segment 2 proved buyers can get emotionally frozen over a $100 to $200 monthly rate move, which only is about $1,200 to $2,400 annually. That's the modern-day dream state. People are trying to save a nickel while they're losing a quarter or honestly a dollar on the other side. That's the war.
Exactly. This is the smoke and mirrors part of the machine. The inception is that buyers have been conditioned to believe. The rate is the holy grail of home ownership. It's not. The rate is just one small line item inside a total cost stack. So let's compare actual math. Best case rate timing win. They save $150 per month or $1,800 annually. Now compare that to the hesitation cost we have already proven. $31,000 in payment burn, $4,100 in missed appreciation, and $14,000 to $28,000 in lost leverage, compared with $48,000 in lifetime financing risk if this volatility repeats. That's a ratio where buyers may be trying to save $1 while risking $20 to $30 on the other side. That percentage math simply does not work in their favor. That's why the rate obsession is a broken totem.
And this is where realistic expectations win the war. Trying to win every small battle. A perfect rate, a perfect Fed cut, a perfect price reset, a perfect insurance window, perfect timing usually means losing the actual war, getting into homeownership. Because homeownership is not won by perfect entry. It's won by realistic math, fixed payment structure, asset ownership, and time in the market. That's how you win.
Exactly. Trying to time the market with the wrong indicator, the rate alone, often creates the exact opposite result. People stay renters forever. And the long-term math, it gets more brutal. If hedge funds, institutional buyers, and fearless asset accumulators capture even a modest 3% in annual appreciation on a $400,000 property, that's roughly $12,000 in 1 year equity growth alone, and more than $63,000 over 5 years before principal paydown. Now multiply that by thousands of families who sat out waiting for the warm and fuzzy certainty. That's how an entire generation can lose the wealth war. Meanwhile, the people who ignored the fear loop are building equity, funding colleges, taking vacations off cash flow, using HELOCs strategically, and expanding their balance sheet, while the renters, they just walk away with a simple security deposit. That's the real world, modern day inception going on right now.
So the real lesson of the broken totem is this. Realistic expectations win the war, while perfectionism loses it, because the dream was never the rate. The dream was believing the rate was the whole story.
We're dreaming?
You're actually in the middle of the workshop right now, sleeping. This is your first lesson in shared dreaming. Stay calm.
And now it's time for our Mortgage 101 Market Dashboard, because this is where we stop talking about the dream and we start talking about the real math shaping what homes feel affordable right now.
Yeah, so here's where the market sits this week. The average 30-year fixed mortgage rate is 6.46%, up from 6.38% last week. The 10-year Treasury is sitting around 4.33%, and that's one of the biggest reasons home payments have felt less affordable over the last month. That move from the high threes into the low fours is what quietly pushed mortgage pricing higher. On the MBS side, the 30-year UMBS 5% coupon is now 98.84, and the 5.5 coupon is 100.68, which tells us mortgage bonds are finally trying to stabilize after getting hit hard through March. That puts the mortgage spread at roughly 2.13%, which is still wider than normal. So in simple terms, buyers are still paying for a volatility premium on top of the Treasury move. That's why the payment may feel higher, even if the news headlines sound calmer.
So the real takeaway for every future homeowner is this. The rate isn't moving in a vacuum. It's being shaped by Treasury volatility, a mortgage bond pricing, and a spread that still says the market is cautious. So if you only focus on that rate, you'll miss the bigger picture. But if you understand the dashboard, you'll understand why the payment changed and whether it's a panic move or just a normal market repricing. That's how you stay grounded in reality.
Come on.
now it's time for everybody's favorite, the Buzzword Breakdown. Producer Ryan, what do you got for us this week?
Oh, we're going straight into the machine this week. Same rules, short answers. First thing that hits, don't overthink it. First off, Manly starts off with Buzzword 1 today, and that is false memory.
Hey, that's the borrower's belief that feels like your own idea.
All right, Anthony, next up we got social proof.
Yeah, that's when repetition replaces evidence and the crowd becomes the source, even though it's not factual.
We're doing some like social psychology. I like it. All right, Buzzword 3, opportunity cost.
Hey, Ryan, that's like trying to save $150 a month while losing $40,000 in future wealth. Just doesn't make any sense.
All right, moving nice and fast through these. Buzzword number 4 today is volatility premium.
Yeah, that's the invisible tax that buyers pay when fear keeps spreads wider than normal. And right now, there's a lot of volatility.
All right, Manly, you got our final buzzword today, and that is reality anchor.
Yeah, I'm the anchor here tonight. Your total monthly payment, not the headline rate.
That one hits. The machine can fake the narrative, but it can't fake the math. Back to you, Manly.
So the lesson today is simple. Don't let a planted belief make a permanent financial decision for you. Because in today's world, the source disappears. The feeling survives. And that feeling, that can cost you $40,000 to $80,000 before the truth ever even shows up. Your job as a future homeowner is not to predict the perfect moment. It's to stay anchored to your local numbers, your local payment, and your long-term future. That's how you beat the machine.
And if today's episode made you rethink even one belief you were carrying from social media and those planted seeds, then we did our job. Like, subscribe, and share this with someone who keeps saying, I'm just going to wait 6 months, because that might be the most expensive lie on the internet right now.
All right, Anthony, and now for today's factoid. For years, millions of people felt like they knew Gilligan's Island, the beach, the huts, the lagoon, the whole stranded world. But the island was never a real place. It was a manufactured reality built on a studio lot and stitched together through editing angles and story design. A place that felt real enough for people to emotionally live inside it. Kind of like the narrative social media builds every day. Sometimes the island feels real until you realize they were never stranded in the first place. We'll see you next week.
Girl from the heart of Wisconsin to the waves of Hawaii. Manly and Anthony keep it real, not salesy. Breaking down rates and the truth you need to know with a little soul and a little homegrown flow. It's the Mortgage 101 podcast where real talk meets home at last. Manly's got that Midwest soul. Anthony brings that island roll when the market swings and you don't go fast.